I think that the unemployment rate will go into a 4.5% to 5% range because of the signs of weakening labor demand that I'm seeing. We'd already be there if it weren't for the fact that after the horrible experience of COVID, and then companies couldn't find their employees anymore, and it created that huge disruption in the labor market. Companies are lulled right now. They'll cut their hours, but they won't cut the bodies. And it's very interesting when you look at the data in the US, because you talk about these non-farm payroll reports. I didn't hear you talk about what's happening with part-time and full-time, right? So we're getting all these jobs, they're part-time. Full-time employment hasn't grown at all in the United States in the past year. This supposedly red-hot economy hasn't created a single full-time job. So cutting hours, moving people from full-time to part-time, that usually presages the very painful decision to have to let people go. But you see, that hasn't happened yet. We've already seen the unemployment rate go from 3.5 to 4.1, as you said, without there being any firings. Imagine what happens when we see the firings. So the unemployment rate is going to be surprising to the upside, and it's not Armageddon, it's not the end of the world, it's just the cycle. 4.5 to 5% is not horrible, but would it represent a technical recession, which nobody believes we're going to have anymore? The answer is yes. It would. But I think that's where the unemployment rate is going. That's going to be a drag on wages. And even Jay Powell has said repeatedly that there's no inflation coming out of the labor market. And that's at a time where we're at 4.1. To which I say, well, if we're not getting inflation out of the labor market, where's it going to come from? Really, for you to have an inflation view, you need the labor market to play ball with you. So again, that's why I think the inflationists, and they're entitled to their view, for sure. Creates a nice debate, but I'm on the other side of that trade. The first thing is that although the Fed cut rates aggressively at the September 18th meeting and then cut again in December, as you had accurately said, at the same time, they were talking the markets out of pricing in rate cuts for this year. And now we're down to basically just more than one. We used to be multiples. And that's what mattered the most. This is a case in central banking. Words matter more than actions. So it's like the leaky boat. They cut rates and then they talk the market into pricing out further rate cuts, and then the yield curve steepens because the front end of the curve will rally on the actual rate cut, but then the longer term part of the curve will see, this is going to be a truncated easing cycle. And that's really what's happened. You layer on top of that the term premium, which is reflecting the uncertainty around Trump's policies. And that's what's caused the back end of the curve to go up in terms of yield and steepen it. It's really hard to know right now what message the yield curve is sending you. I think there's really two things, and it's not about the economy. It's about the Fed's reaction function, and it's about concern that fiscal policy is going to remain in a state of disarray. I think that there's a fiscal premium at the long end of the curve. The Fed has been able to pin the front end by its own actions, and now they're saying they're going to pause for the next several months. There's not a full rate cut priced in until July. The back end is reflecting Trumponomics. In a sense, it's not about inflation expectations. It's about two things. The deficit's not coming down, despite Elon Musk. He wants to cut taxes. Of course, he wants to cut spending, but there's not enough spending to cut, unless you're going to attack entitlements, which he said he's not going to do. And so that's what the bond market's telling you. There is a fiscal uncertainty premium that's keeping long-term rates elevated. The Fed's already anchored the front end, so the yield curve is steepened. I don't know what the economic message is. It's hard to say. I had fully expected that we were going to see a recession by now, but we haven't. And there's a reason for that. And if you remember, I said that in my business, your assumptions drive your conclusions. And if your assumption is wrong, well, ipso facto, your conclusion is going to be wrong. My conclusion was wrong. And where it was most wrong, and it comes down to, the data that we were first talking about. And this is what's not included in private sector surveys. And it's not included in the Beige Book because the Beige Book are surveys of business executives across all industries. Is all the government spending that's going on in the United States at this very moment as we make this transition. $2 trillion deficits year in, year out, 6% of GDP. This will be the third year in a row, unheard of, unless you're fighting a recession. So you see, it's interesting. I'm being told there's no recession, but we have a fiscal policy in the United States. Marx and Engels are probably just smiling in their grave. We're running a fiscal policy aimed at fighting a recession, but there's no recession. It's like a cognitive dissonance. So all this fiscal stimulus is what clogged up all the monetary policy tightening that I was expecting was going to generate a recession. This is unprecedented, unless you're fighting a war or unless you're fighting a disaster like COVID or you're fighting a recession. We have a fiscal policy that's aimed at fighting a recession that apparently doesn't exist. Think of how illogical all that is. Government spending in the United States is up to double digits. Even the R&D spending related to AI is not going up as fast as government spending is right now. You have a growing economy in the United States. We can debate whether it's 3% or 1% or something in between, okay? Government revenues are down year over year. Because not only the spending, but all the subsidies, all the tax subsidies, the CHIPS Act, EV subsidies, default relief, debt relief for students, all this stuff. So for the first time ever, we have an expanding economy, but we have revenues going down. Revenues usually go down for Uncle Sam when you're in a recession. So there's so many strange things happening. But what really caused me to get my call wrong was I did not see that we were going to go through this elongated period of such fiscal support, government support. The average OECD country outside the US is running a deficit GDP ratio of 3%. We bellyache about Canada. I don't believe that Justin Trudeau, ultimately got turfed out because of fiscal policy. I just think basically people got tired of him. Canada's deficit is 2% of GDP, throw in the provinces 3% of GDP. That's why interest rates are so much lower in Canada, is we do not have that same degree of fiscal stimulus. Back to the question, the steep shape of the yield curve is reflecting the doubts that the market has that Trump will be able to rein in the deficit. Although I've been bullish on bonds, the only friends the bond market has right now is the Freedom Caucus, those 38 fiscally conservative members in the House. The question is, will they stand their ground or will they get bullied? Trump had to get off the golf course, think about that, to get on the phone to save Mike Johnson's job as Speaker of the House. So a lot will depend on the fiscal side, what happens in the House, because the Republicans only have a one-seat majority. So that'll be very interesting to see, because if left unchecked, the deficit's not even going to be $2 trillion this year. It's going to be more like $3 trillion. We have the first 3 months of the fiscal year, and the deficit's up like 30 or 40% from where it was this time last year. So that's what the shape of the curve is telling you. No other economic message other than concerns over the state of fiscal policy in the United States right now, which have yet to be resolved. I could tell you I'd be buying the bleep, 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 bleep out of it if that were the case. There's always the risk of an overshoot. The last time we got to 5% on the 10-year note in October of 2023 was a great buying opportunity. And remember, there was one point in September of last year we got to 365. So I'd say that would be a very nice buying opportunity. Is it possible? 100%. But it would, to me, classify an overreaction. There are conditions that can take us there. I could be wrong on the inflation call. It could be that the spending cuts don't amount to anything, that he cuts taxes, overly stimulates aggregate demand, that productivity doesn't hold up as much as I thought, because inflation is about supply and demand, right? So you have to have a base case scenario. I do have confidence in that forecast, but there's no such thing as 100%. A lot of things would have to happen to break 2 or above 5% from where we are right now, but I would say that would be one great buying opportunity. And that something I just said reminds me of something I want to come back to, because everything you had mentioned about tariffs and immigration and so on and so forth, all inflationary. And you mentioned Paul Tudor Jones, who I know very well, but we didn't talk about AI. If the stock market is right about AI, then we're going to have a productivity boom. You cannot justify the valuations in the stock market today unless you believe that AI is going to drive a major productivity boom that will cut corporate costs and boost productivity, boost corporate profitability at a rate that will be triple the historical norm over the next 5 years. That's what the market's telling you. Well, you don't need to do much more than get through first-year economics to know that productivity is an inflation killer. If you think that there's going to be wage increases, really? The robots are coming after our job, by the way. So ChatGPT, all this stuff is going to create a lot of job uncertainty, and it's going to create tremendous productivity. We don't know how much. Nobody talks about that. They talk about tariffs. They talk about tax cuts. All this stuff is all inflationary, but inflation is a complex thing. There's a lot of factors that influence it, but what I'll tell you is that productivity has a time-worn inverse correlation to inflation, and nobody talks about that. You go to the last set of FOMC minutes, it's all about Trump. Hardly anything about AI and what that's doing to productivity. So that's just another layer of analysis that leads me to that view that inflation is not going to be a problem, and that if for whatever reason bond yields ratchet up further, sentiment on bonds right now is so depressed. It's like almost as depressed as what sentiment was in the stock market back in March of 2009. So if you're a contrary investor, you have a contrary antenna at the bond market. You can pick up almost 5% in the 20-year part of the curve right now. With inflation, most of the inflation measures are running close to 2%, not 3. The ones that count, like the core PC deflator, will probably be at 2% by the end of the first quarter. And almost 5% that you can garner in a 20-year treasury. I'd say you probably pick that up right now. We had a huge decline in the deficit GDP ratio under Barack Obama, but of course it wasn't him, it was Congress. So the House in particular will have a big say on how this happens. Trump already said in the election campaign, because he wanted to get elected, he wasn't going to touch entitlements. That's unfortunate, because without small changes to entitlements, so small tweaks, they can have a very powerful actuarial impact on those deficit projections, but he's not touching entitlements because, of course, you're entitled to them. They were brought in the 1930s during the Great Depression, and like everything else, what is supposed to be temporary becomes permanent. We're not going to inflate our way out of it. I don't know if we're going to grow our way out of it. Maybe AI and ChatGPT and these generative chips, maybe we will grow out of it. Who knows? It's interesting. Look what the internet did. Really, 3-4 years after Netscape went public and brought the internet to the masses, the US government is running fiscal surpluses under Bill Clinton. Bill Clinton cut taxes, so it can happen. That will come down to the extent to which this shift in the innovation curve, which is what it is, will generate the revenues that will cut into the deficit. I'm not banking on, okay, so Trump's going to freeze civil service employment. That doesn't impress me too much. I mean, you want to get to Elon Musk's $2 trillion target of spending cuts, you're going to have to let a lot of civil servants go, not just freeze. It's going to be a tough task. But the key will be this AI craze and what that does to productivity, especially at a time when we're not going to have the same growing workforce because, as you mentioned, immigration is going to be a constraint. So we're going to need productivity as a source of economic growth from the supply side. So I'm not going to say nothing is impossible. It's doable, but I come out more skeptical. But it really will be AI being the driver of those revenues. The tax cuts themselves, if he gets them through, they're not going to pay for themselves. And don't forget, he's not just talking about tax cuts for corporations, getting the tax rate, top rate down to 15%. He's talking about no tax on tips, no tax on overtime, all these nice, I was waiting between him and Kamala Harris during the campaign. What's next? Like root beer and the water fountains? Is that going to happen too? And now we're talking about, the SALT deductions. All this stuff adds up. You mentioned about the fact what the debt is now compared to when Trump took office. The debt to GDP when he took office in 2017 was 100% of GDP. Now it's 130%. But what's more pernicious is how structural it's becoming. They're following in the footsteps of Canada of the early 1990s, because when he took office, and this is the most important statistic, in Trump 1.0, the interest coverage ratio, or let's call it what is debt service costs absorbing out of the revenue pie, was 8%. Today it's approaching 20. And that's the big problem, is that interest costs are starting to eat up a larger and larger chunk of Uncle Sam's revenue stream. And when you start breaking above 25%, then you start running into trouble, even the reserve currency. That was the Canadian situation back in the early 1990s. When that ratio broke 25%, the interest cost in the debt and how it ensnared fiscal finances. That's the big concern, is what's happening on the interest on the debt. So that's when it becomes increasingly structural. That's when you start getting nervous about the treasury market. Tailed auctions, maybe even a failed auction, God forbid. And that's why this has to be tackled now. The only body that's going to tackle it, like I said, are 38 Republicans in the House. They either have the courage or they don't, but we're going to find out probably in the next 6 months.